I think 2019 was the year of central banks, where central banks managed to create a bullish equity market by reducing interest rates almost everywhere around the world. I think 2020 will be the year where if economy recovers, central banks would be forced to be more hawkish and would have to think of at least stopping cutting rates, and in a few cases maybe they may have to also think about increasing rates, and that would result in a more volatile equity market, particularly in the second half of the year closer to the US elections. So our view on 2020 would be volatile markets, determining that asset allocation would be the best way to invest, because in volatile markets that turns out to be the best way. See, the problem with the other models is that investors should gather the interest to invest in an undervalued asset class where people are not with them. Today, for example, credit risk is one such area where we are in an undervalued asset class, or micro caps and small caps would be another area, along with value stocks. So I would say that the challenge is that the alternate to asset allocation is to focus on the areas which have done very badly and invest in them. However, in my career as a fund manager, I have seen that less than 10 out of 100 can gather the guts to invest in an asset class which has done badly and is undervalued. See, broadly, given the valuations of the aggregate equity market, we think we are in a moderate return period. And we believe that equity markets cannot give very large returns. However, the economy is can improve from where we are here, given that many of the indicators that we use to determine how economy is doing, like credit growth, power demand, airline transportation, passenger growth, automobile growth, all these indicators are actually saying that things can improve from here. So we are possibly in a period where economy will improve from where we are today, but markets are already kind of partially priced in for the economy improvement, barring small caps and value stocks. The rest of the market is already priced for an improvement in the economy. Actually, we are clearer on the next 3 to 5 years. With the next 3 to 5 years, we believe that small cap followed by mid cap followed by large cap followed by mega cap is the order of attractiveness. That is, small cap is the most attractive and mega cap is least attractive. But is it a trend we expect which will play out in 2020? May not. We are more confident that this trend will play out in the next 3 to 5 years than playing out in the year 2020. Actually, we have also gone wrong many times. So what we do know is if earnings recovery comes in a full way and credit growth increases significantly, we are possibly at the top of the business cycle. So the fact that earnings recovery has not come in is actually giving us scope for an improvement in their business cycle and giving rise to scope for returns to be made in equity market. If you go back and look, when was earnings really good and credit growth really good and economy very good? It was 2007. Was that a year to invest in equity or take out money from equity? It was a year to take out money from equity. So I actually fear very high earnings growth and very high credit growth, because what worries me is at the top of the cycle, many investors make mistakes. All I know is that I know less than most other people, and most other people may also know very little. All I know is if it escalates and there is a war, then we are likely to have meaningful downside to equity markets. One of the interesting things I've learned about geopolitics is neither I nor most people know exactly what will happen. And that is the reason why I believe 2020 is a year of asset allocation, because it's very difficult to predict what will happen in the Middle East or what will happen in US elections, or what will the global central banks do if the economy revives. So we think that, except at extreme bottom where we are not, or at extreme top where we are not, it is wise to be an asset allocation rather than trying to predict what will happen to the Middle East situation as we speak. It's more difficult to predict for aggregate. For a person like me, I believe that I would be overweight small cap, I would be underweight megacaps, I would be neutral equity, and I would be overweight anything which is moderate duration and has some credit. Actually, in the near to medium term is more difficult to judge currently, but I've had this view over the last 1 year that I would like to bet on sectors which have done badly for the last 12 years. So on that basis, we had a positive view on telecom. We had a positive view on power. We had a positive view on some of the capital goods companies. Out of this, telecom worked. In our opinion, clearly, pharmaceutical sector is another sector which has done very badly for the last 4 years, which we find pretty interesting to look at for the medium term from now. We don't have sectoral preferences at this point of time. Broadly, barring consumer driven sectors, the rest of the small caps are even cheaper. So I would say that I would be still cautious on the consumer driven small cap stocks trading at very high valuations. X that I would be positive on all the other small caps. I would shy away from quality stocks trading at trailing price to earnings of above 50. I believe that, in the 1970s, there was a phenomenon called Nifty 50 in America. That was composed of all the quality stocks of America where people were willing to give 50 PE. And those stocks actually over a decade delivered suboptimal returns. In our opinion, we are possibly in that kind of framework, and I would be very, very cautious on the best companies of India.